Operation Twist. Since last week, a fascinating code name has been trending on the internet. Operation Twist, rolled out by RBI. This seemingly secretive mission is all set to ignite the bond market without the use of any fireworks, that is. As the name suggests, this operation was aimed to work like a plot twist. But what is this twist all about? What is it? Operation Twist is a name given to a monetary tool that the US Federal Reserve had initiated to influence the prevailing rate of interest in the markets. This tool essentially aims at changing the shape of the yield, hence the name Twist, though simultaneously buying and selling of long term and short term government bonds. In India, RBI puts its version of Operation Twist on Monday by buying 10,000 crore worth of 10-year government bonds while selling 4 short term government bonds adding up to the same value. This intent is to moderate high yield long term interest rates in the market and bring them closer to the repo rate. In the US, such as tactics were first used in 1961 when the economy was recovering from recession post the Korean War. In order to boost the spending, the Federal Open Market Committee tried to flatten the yield curve. A flatter yield curve reduces the excess compensation that the bond holders earn for the added risk of holding bonds for a longer tenure.
Why is it important? Despite a cumulative reduction in 35 basis points in India's policy repo rate since January 2019, bank has affected a deadline of just 40 to 47 basis points in their weighted average lending rates in the same period. Even the mandatory linking of banking lending rates to an external benchmark has not helped. High market yield on the 10-year GSEC influenced bank lending rates on vehicle, housing, and other long-term loans, hurting the retail borrowers. This seems to have prompted the RBI to compensate for its unexpected pause on December 5 with the surprise announcement of Operation Twist. Though the amount of securities bought and sold on 23 December was only worth 10,000 crores, the bond market still welcomed it with a big cheer. This was in anticipation of several such announcements in future. Post the announcement, the 10-year GSEC yield dropped by 20 points on intraday trade to 6.6%, while the yield on shorter tenure bonds 5-year rose 16 basis points 6.67%, making a flatter yield curve that also helped bring down cost for government.
Why should we care about Operation Twist? If you have fixed income investors sitting on a debt heavy portfolio, softening yields of the long term bonds may help your portfolio get into the green. There is good news in store for borrowers as well. The high yields on a long term government borrowings had led to bank pricing their retail loans at higher rates. This loan can now be expected to get slightly cheaper with Operation Twist. Cheaper retail loans can boost consumption spending, which accounts for a good chunk of the GDP.
The bottom line, Santa may have arrived early for the bondholders with the Operation Twist. If there is an overshoot in the inflation and deficit number, you may need to watch out for other twists in the tail.